Welcome. About 11:58 Eastern time, so we're going to wait the typical, I think if there's a typical now, maybe 2 minutes after the hour, and then we'll get started. So we'll get settled in. Those of you who just joined, we're going to give it, I think, about another 90 seconds, and we will get started. So welcome. Pretty large group signed up today, which is great I think we're still in the doldrums of summer here. Right. I've got 12:01 in about 20 seconds. So we're going to go ahead and start. So I only wish I were that precise with other things in my life as well. In any event, I am Brian Klontz, president of Charitable Solutions. Have our managing partner, non-cash assets, Ryan Raffin, with us today. He'll be leading most of the webinar. I'll give sort of the side commentary, which may or may not be helpful as we go through, but maybe a couple of anecdotes as well. But this is a very, very important topic and very much a trend for what we're seeing. So talking about unique donor investment options, in particular concentrated positions and direct private equity and real estate investments within DAFs, supporting organizations, and LLCs. And so a couple quick points before we get started. First, some housekeeping. As many of you know, we will not be sending out the slides directly. However, we will be sending out the best of either today or Thursday's webinar link. As you know, Ryan has at the end of this presentation all of the list of our past webinars, and I think we're up to 35, 36 or so, again, all free. But those are on our website, which I think most, hopefully, of you know. So it's under the Charitable Solutions, LLC.com, resources, webinars. So this will be posted next week. We do prefer very much the questions to come through the Q&A. Chat is a little bumpy, so if we can do it Q&A, it's a little bit easier for us to scrape. So we will take any of the questions from this week, both today's and Thursday's webinar, answer those questions, and just post those along with the actual webinar recording. So that's sort of our way of disseminating the information. So why are we doing this? We've had a number of webinars that I know Ryan is going to allude to, as I will in the past, and sort of our pieces of this. But in particular, more and more donors, really in the last 4 or 5 years, seem to be motivated by, in my view, two things, and love Ryan's comments here too. But I did a webinar, I think February, March of this year, about sort of donor motivation. So for the mega donor, what are really driving them to make some of these gifts? Why are so many more charitable, perhaps, than generations past? And there are a number of donors that we have sort of direct conversations, which is almost verbatim of, I love doing this thing. And at this moment in our history and from their particular perch, they seem to be really good at doing that thing. real estate investments, international real estate investments, PE investments, whatever that happens to be. And for better or worse, society is rewarding them in a pretty big way for that level of success. And interestingly, at least the ones that we're talking to more and more are not saying, I can't wait to take, these sort of winnings and buy another jet, maybe doing that, I don't know. But we'd like to actually be able to deploy or allocate a lot of that for charity during life and at death. But if you think about Warren Buffett, which I'd mentioned before, in a weird way, if you look at it from a pure sort of financial point of view, if he's planning on leaving 98% of his wealth to charity, the point is like, why not just give it all away now? Just give it away now, see impact now, take maybe deductions to the extent that he needs that now. And I have no clue why he's doing this. I'm not suggesting that I do, but my guess is he probably says, I'm a pretty good investor. And I took a small amount and I made it into a big amount. And if I gave that to charities, would I still be doing the investments? They would be doing the investments, but I kind of like doing this and I kind of think that I'm good at it. And maybe, not saying that he thinks this, but maybe he's thinking, I can outrun the charity's endowment. I can invest better. And if I can get higher returns, generally relative to risk, then that actually will create more incremental charitable benefit. I don't know if he's thinking that again, but I will say that a lot of the donors that Ryan and I work with say that. I love doing deals. I'm 72. I still love doing deals. If you tell me that I can't do that anymore, I would not be a happy person. There's sort of that one chunk. And sometimes these are meshed, not necessarily mutually exclusive. And they'd also say, and in doing these deals, I'm making this number up, 14, 16% rate of return pretty consistently over a long period of time. And I have particular channels and relationships and opportunities that most other charities wouldn't have. So if you told me I'm going to take this capital that I'm growing at a very high rate, and I'm going to move that into a charity, and again, making this up, and they put it into a balanced index fund, he's like, that's like a punch to the stomach for me. I can earn the charity more. So at least from a very broad perspective, we're hearing a lot more of those types of donors directly or indirectly with these types of investments. And we have another donor. We had the company donated when it was private. It went public, and he said, I've heard all this stuff my whole life about diversification. I don't diversify anything. I have two assets, my company and basically his house. And he said, and I watch that company basket really closely. So I would prefer that actually be kept in a concentrated position of this public stock, concentrated positions. So this is sort of a much longer sort of context setting than we certainly have done in past webinars, but I wanted you to know why we came up with this particular topic, because we're just hearing it more and more. So much so it represents about a third of all of our assets. It's about $500 to $600 million in assets are in these buckets. I would say 7-8 years ago, it was maybe 5%. Now it's like 35%. So this is a rapidly growing area for us, because it's a response for how these, in particular, baby boomer donors view themselves and their role in philanthropy. So with all of that, I will jump ahead. So sorry, I'll jump through the other things pretty quickly. So about us, many of you have heard this before. If you want to go deeper, watch another webinar. Emergency assistance fund stuff. We actually just created a Maui fires fund. We're already doing hundreds of grants into that horrible situation, but that's our emergency assistance foundation side. You can see there we cover about 12 million employees for personal hardship and disaster grants. Professional advisor, CE. So we do a lot of this type of thing. My fall looks pretty busy, interestingly, but do a lot for community foundations in particular, but for donors, advisors, whether that's a state planning council, their own sort of CE, nonprofits, staff, and board. Charitable appraisals, we have now a team of 5 people doing a lot of qualified charitable appraisals. You can see all the different things that we do there. Our tagline is, if you can give it to charity, we can appraise it. Gift annuity stuff, I'll sort of gloss through. Risk management, sort of that top middle. Do a lot of, I finished one up yesterday, a gift annuity risk audit. And so we basically look at very large pools and be able to assess risk through a report that we provide and present to staff and or board, and in particular have a niche that we've done for over 20 years now around concentrated risk. So very large gift annuities relative to the pool in particular, and sort of should that be reinsured? There are other ways to do it other than reinsuring. And so what might be best to mitigate some of that risk and maximize the final residuum returns there. National Gift Annuity Foundation. So it's a full outsourced model, turnkey that we are able to provide. It's about, I think, 350 charities ish have used us for that. We need to update this. It has 600 contracts. I think we're around 770 contracts now, and we're around that 65 million or so in assets. So that is growing very, very quickly for us nationally. And so certainly with the 2.0 and the QCD, which we have a whole webinar on that too, has really sparked a lot of interest, never mind the interest rates just going up, obviously, and the ACGA increasing rates as well. So basically, it's a full outsourced ops, and 100% of the residuum going back to the charity at the end, or charities to the extent that they have multiple interests there. And then the final thing that Ryan leads is the Decamai Foundation, which is our non-cash asset area, anything that is illiquid and complex that other charities are not able or comfortable receiving. We are able to do that. As many as you know, we're doing roughly one completed gift per day. That's super weighted toward the last 60 days, but if you sort of mush it, it's about one per day. And they average about 4.4 million per donation. It takes about 8 to 10 leads for us to complete the one. And then you can see there the average fee is about 1.4% within all of the remainder of that granted back. So we are a national donor advised fund, have both corporate form, trust form, almost 24 roughly single member LLCs that we use within that for risk management within that structure. But the bottom line is we don't manage anything that's liquid. So we only take an illiquid and it all goes out. Gift annuities, only take a gift annuities, all goes out. And do this with CRTs as well. So that's basically it. Jumping ahead briefly, because I want to give Ryan plenty of time here. These are some of our activity from last year. Those of you who have attended past webinars have seen this, but you can see it's about 154 donations. That was down about a third from 2021. So 2021, we were about 1.2 billion in donations. Again, 100% of which that were otherwise declined, not including CGA and CRT activity, as you can see in the top. But you can sort of see the breakdown. The point is this, that a number, not a ton, but a number of the real estate gifts where donors were saying, I'm really good at real estate investing. We have one in particular, I think it's in Denver somewhere. I know Ryan worked on this one. And so it's an office building and that's very good cash flow, no debt, fully leased. And he said, look, I think that's a good investment. And it's maybe spinning off 6, 7, sometimes 8% net operating income every year. And he said, so if I could wave my magic wand, I actually don't want that to be sold. I've got long-term leases, solid tenants. I'd rather you keep that recommended in the donor advised fund so that I can take that 6 or 8% that's coming off every year and I can give that away. But I actually would like this to be a longer term hold. So a number of these that we're receiving, whether that's real estate or business interests, are meant to be longer term holds. So we're going to talk about that. That's the concentrated piece. But then Ryan's also going to talk about more and more donors are saying, now that I have maybe that real estate interest that I sold, maybe now I'd like to do a direct investment in my donor advised fund into another real estate investment or into a private equity opportunity so that that becomes then the investment within the donor advised fund. So you sort of see the rest of that too. So with that, Ryan, I will pass it over to you. Again, I'll make commentary. I'll sort of go off video here. I will be doing sort of Q&A as those come through. But again, I hope you sort of understand the motivation as to why we're doing this, because we're hearing more and more from donors about, is this possible to do concentrated risks, hold particular assets that are donated, or do direct investment? So Ryan, take it away.
Great. Thanks, Brian. So a quick agenda, just what we're going to talk about for the remaining 45 minutes or so. A lot of different ways you can come at this topic. First, what are the general different types of investments that we see? Brian's already mentioned most of them. So I'll go over those, how they're different, how these investments actually get funded, whether a charity should do the investment, and once they've done the investment, how do they monitor it? How do they monitor the returns? What are the implications more broadly for the charity in terms of fiduciary responsibilities, diversification, audit implications, and then finally a look at the different vehicles that a charity could invest through. Not the different types of investment, but the different ways that the charity could make the investment. So quite a number of different angles to look at this sort of more direct investment subtopic in terms of complex charitable giving. So just setting the table there, and let's dive right in. The different investment types that we've tended to see, three types primarily, 3 or 4 depending on how you want to count it. Startups, reasonably common to see private startup investments. Some type of fund investment, which normally means either venture capital or private equity. And then finally, real estate investments, as Brian mentioned, and those can take a number of different forms as well. So working through each of those, startups, the advantage there is normally with a startup, it is a C Corp. So we're talking about something your charity is getting a 1099 for rather than a K1. It's not a pass-through. It is a little bit simpler than other investments for that reason from a tax standpoint. So that's normally good. The downside is that if you're going to do an investment that way, it's part of a larger funding round, and those can be quite large indeed and have certain time sensitivity to them. And then everyone watching this has seen this in the final point that I've got here. With startups, they do tend to be quite high risk. There is the potential for a high return, but the startup can also fail. And I'm sure everyone can think of cases where they've heard of famous or infamous startups flaming out spectacularly. That is a risk that can happen. On the other hand, investment funds, whether it's venture capital or private equity, those do tend to be a little more diversified. So you've got a little more risk spreading there because they tend to have, in most cases, a portfolio of investments within the fund. That means multiple portfolio companies that they've invested in. Those typically are pass-through investments, often limited partnerships, almost always limited partnerships, really. And that means, of course, there is a general partner. That's the fund manager. That's the person or team that is selecting the investments. They're selecting and monitoring these portfolio companies and really managing the investment for all of the limited partners, which would include your charity if you were to invest. And then finally, with real estate investment, that can really go in a number of different directions. Like Brian mentioned, you can have direct investment, just the charity taking money and buying some income producing real estate that will hopefully also appreciate in value. But it doesn't have to be that way. You could have something more like a REIT, something more like an investment fund. There could be a portfolio of properties which would look probably structurally very similar to what you would see with a private equity type fund. So real estate investments are probably where you see the most variety in terms of what's actually owned and how many assets are we talking about, how many people are involved. That's where it really runs the gamut, and you really have to have a discussion with the donor and with any other investment managers to understand what you're getting yourself into and what the assets are. In terms of funding your investment, that's probably the most important question. I think even more so really than whether you should do the investment at all is how are we actually going to pay for it? You have to understand what the total size of the proposed investment is. And it's important to understand, I think, 2 things there. First, what you're being asked to pay up front may not be the same as the total investment that you're signing on for. That's where capital calls come into the picture. The other thing to consider, I think there's such a thing as an investment that's just too small to be worth the trouble. And the charity should consider what sort of their minimum threshold for even undergoing an investment like this, or even evaluating an investment like this is. If it's a $50,000 investment, that may not be worth the trouble. Capital calls, as I mentioned, that is something to really be aware of. What's outstanding? When are those due? You don't want to have an email notice for a capital call from the fund come in, say, there's $100,000 due, usually not more than 2 weeks from now. They usually don't give you a lot of time to send over the money, and have that email go to someone who's on vacation, and then you miss it. That can be a real problem, not just with the fund who's expecting to have the money, but with your donor. And that's, again, goes to the next point. How is the donor going to be funding this? Because they're presumably going to be sending you, the charity, money. But it's not just as simple as saying that. Where's the money actually coming from, and how much are they sending? One thing we've run into a few times is with a capital call situation where maybe it's $1 million commitment, but only $200,000 is due up front. It's much easier for the charity to simply get the $1 million from the donor and then send that on to the fund. That way you don't have to worry about any future capital calls. You've paid everything. Easy for the charity. The fund usually likes that too, because they've got all the money, but the donor doesn't usually want to do that. Because, as Brian mentioned, usually the donor is thinking, how can I generate additional returns? Only $200,000 is due now. I want to put that other $800,000 to work and turn that 800 into 900, another million, whatever. So there has to be a conversation with the donor about, okay, this is what we're signing up for. How much are you going to send us? And when is it going to come? Because that's really easy to overlook. It's one thing for the donor to say, you've made the $1 million commitment, charity, I'll send you the $1 million, but they have to get it to you on time. Particularly with investments in startups where there is some kind of funding round going on, those are usually at least multi-million-dollar transactions, sometimes tens or hundreds of millions of dollars being moved around. The charity is a small part of that. The company is not going to hold up a funding round and the close of a funding round because you, the charity, don't have the $1 million yet. The donor needs to be certain that they're going to be able to either wire you the funds, or, and this is where you can really have problems, move the cash as a grant from a private foundation, or more often a donor advised fund, to your charity. So you have the cash in hand, ready to make the investment before it's due. You don't want to be in a situation where the donor says, I'm going to grant this from my other donor advised fund, and that has to go through some kind of approval process that's going to take a week or more, but the closing is at the end of this week. That's going to be very difficult, and then you have to have a hard conversation with your finance team about whether you're going to front the money until the grant comes over. Best to avoid that if at all possible. Understand what the deadlines are for funding these types of investments, particularly when it's a startup with a funding round and there's a hard deadline to participate.
And Ryan, a quick point there. Everybody, I think, can tell just, which I really appreciate your perspective. You're young, but you've been scarred by this too, which is good. It's all about wisdom. So a great question came in about indemnification, and I guess my only point would be there is at least a number of the ones that we do, not all, but tend to be pretty large. And so an indemnification, to be clear, I think in terms of what the question was, is usually where, as Ryan mentioned, that we would have to otherwise front the money. And so if these are large amounts for most charities, that I can't even imagine the level of approvals and committees and emergency alarms that would set off. Perhaps not, but I think practically speaking, that is a bit of a challenge. I think we've done that maybe once or twice with particular donors that already had very large funds with us. So if something went south, that we were still protected, but that still means that you've got to have sort of money liquid, not invested. That's, sold through settlement, cash in, wire out. I mean, there's still some tail to that. But I would suggest most charities, while we have indemnifications within our memo of understanding, I think practically speaking, that's a little bit of a maneuver. And remember, if there is a capital call as an example, and it doesn't get paid, then there are usually some very, very nasty and clear provisions about what happens. I mean, are you basically, completely diluted, or, whatever that happens to be. And then so hopefully in working with the donor, that is sort of a sword of Damocles that's sort of hanging over, everybody's head about, hey, we need to get the liquid funds in as quickly as possible. And we even have some donors that we just sort of hold cash for, or it's invested sort of short-term cash that's very liquid, because we know either some new investments or capital calls are coming up. So, but as Ryan said, some of these donors like to, land the plane on the aircraft carrier, 10 minutes before, their gas is out for some reason. That it's just important to understand that sometimes is the mentality, and sort of getting all of those puzzle pieces moved timely can be a real challenge, and hair can fall out in chunks doing that sometimes too.
Yeah, I mean, absolutely. And I think to the question about indemnification agreements, that actually goes to the first point on this next slide, who needs to sign off internally, because I think it's a fairly safe bet that council is going to suggest or require that there be some sort of donor indemnification agreement. And that's part of the kind of due diligence evaluation, which, as I was thinking about these slides in this presentation, the sign-off question is kind of twofold, because first, I think you're probably going to need to get a sign-off on even considering doing this type of investment. So who needs to approve even starting this process? And then once it's underway, who needs to be looking at the various pieces of the due diligence? Because the CFO is probably going to want to look at the financial information, whereas your counsel is going to be the group, especially if it's a group of internal attorneys and external counsel, they're going to be looking at probably the governing documents, the legal documents that you as the charity are signing on to. So very likely that there is going to be a lot of sign-off needed to do this type of investment, both in terms of considering it at all and considering the specifics. And this is one of the big problems, and this goes to a question that just came in while Brian was talking. What kind of due diligence do you need versus what is available? Often with these types of investments, you're not seeing the type of financial information that you would really like to see. And if you're looking for audited financials, you're not going to get those. I mean, it's just not going to happen with this type of investment. I mean, unless it's a very mature startup that's been through several funding rounds already, they're just not going to have audited financials. Early stage companies don't have that. Venture capital funds don't have financial information because they're newly formed. Private equity funds, same thing, they're newly formed. Real estate investment, maybe you might be able to get cap info from the seller of the real estate, maybe, but probably not. I wouldn't count on it. So you're going to get projections in most cases. And this kind of goes to the question about how much do you rely on the advice of the donor? You kind of have to have some trust and faith in their ability to evaluate these types of investments, and have trust and faith in your own abilities, because the important thing is that you as the charity understand your appetite for risk. The donor might really think it's a great investment, and they might be right. But if it's riskier than your board has an appetite for, it's probably not worth pursuing unless you can convince the board, and that's a whole other conversation. So there does have to be, I guess, a gut check in terms of understanding what you as the charity are willing to do and how much trust and faith you have in your donor and their ability to assess these investments. You might see a prospectus or a PPM. Again, that's more in the way of projections. What you will see for sure and what your council will require: shareholder agreement, partnership agreement, maybe articles, bylaws, things of that nature. Those legal documents, you're going to see those. You're going to need to accept those as they are. There's probably not much room for negotiation. And finally, you, the charity, are doing this due diligence, evaluating the proposed investment. Consider that the company might be doing due diligence on you as the investor as well. And that can be time consuming. We've run into this a few times where it was really serious KYC and AML. Usually that's because it's a European fund where the KYC requirements are a little more intensive. That means the company's going to do some significant due diligence on who the investor is here. They're required to do that. Again, not much wiggle room. They're going to collect a lot of information on your charity, and you're going to have to provide it to them. At the very least, you're very likely to see some sort of required representations as to qualified investor status. And this is where maybe everyone watching this knows this already, but for me, I had to learn. You often see a required attestation as to accredited investor status for the investors who are getting involved with this fund or this company. They have to basically show that they're qualified and attest that they are. And that's called, most often you'll see it as an accredited investor. The good thing is there are about a dozen different ways to satisfy that requirement. There is one specific to 501c3s. And I wish that the first time someone had given me this long list of items and who satisfies what, I wish someone had told me, oh, there's one that's specific for 501c3s. So charities are considered under the regulatory requirements here by the SEC. So just keep that in mind when you're thinking about, well, are we an accredited investor or not? Look at the 501c3 requirement. It's pretty simple. Don't look at the others. They're probably not relevant, and you probably couldn't satisfy those requirements anyways. So now, say we've gotten through all of that, and you, the charity, have actually made the investment. Well, now what do you do? Because it's illiquid for the most part. If it's a startup, there's probably very little income for the foreseeable future. If it is a venture capital fund, same thing, since they invest in startups. Private equity, probably not, since all the cash that was raised by the private equity fund is being used to improve the performance of the companies they invested in. And if it's real estate, well, there's probably a little bit of income, but not much, because we're just talking about rental income, really. So what's going to happen? What should you, the charity, be doing? You're going to have to collect tax reporting. As I mentioned, 1099s for startups in most cases, K1s usually for private equity, venture capital, and real estate fund investments. That's also where you're more likely to see some type of UBIT. That's something you should be thinking about, but you're probably not going to get a really good projection on how much UBIT is actually going to be generated by this investment until you start getting K1s, which of course don't come until you've already made the investment. So know that that's likely. The good thing is private equity funds, venture capital funds, they have a lot of experience with exempt org investors. They understand UBIT. And if you ask them what type of UBIT are we likely to see, they'll at least have some answer. And when K1s are being sent out, you can ask them, okay, is this taxable income? They're going to know. They're going to have a little more guidance for you. compared to probably the startup wouldn't know anything about UBIT, even if the income was taxable. And real estate investors, probably they're not going to know much about UBIT, which is unfortunate because those investments are often leveraged. And that means that there is a UBIT component. So tax reporting, that's going to be ongoing. There should be some other annual or quarterly reporting that all the investors, including the charity, is receiving. At least some type of annual shareholder or investor statement report. Hopefully you're getting something more often than that, probably quarterly. You're going to want to take a look at that. You're going to want to talk to your donor, because if they are involved with the fund, involved with the real estate, involved with the startup, they may have some particular insights that is not really reflected in the annual reporting. So talk to the donor. That assumes they have an ongoing relationship. They might not. Real estate, you're going to see more activity because this should be hopefully fully leased, generating some kind of regular income because of the rental and lease payments. That's going to require probably a little bit more active attention. You're probably getting some kind of monthly reporting in that case. So that's something to keep in mind with real estate in particular. When will liquidity opportunities be available? Again, that's going to depend on the asset. Real estate probably going to be generating some income almost right away, almost immediately. It's something you're going to want to talk to the donor about, get a feel for their expectations, because there's two ways you're going to see liquidity. One is from distributions, and the other is from the sale of the asset. Distributions, you're going to see those more often in venture capital, private equity, real estate investments, where there is monthly or quarterly some kind of income coming to all the investors. You're not likely to see that with a startup investment. They tend to hang on to all their cash for their operations. In terms of selling the asset, real estate, of course, can and is always sold eventually. So there's going to be some sale for the real estate at some point. You may not have control over that, but eventually there will be a sale. VC and PE type investments, those actually are not sold in most cases. It's the portfolio assets, the companies that those funds invested into, those are sold. And then the cash from those sales flows upstream to the fund and to all the investors. So you're going to see, when there are sales, you're going to see larger than normal distributions. And that's where you'll see the return from the sale of the underlying assets. Startup stock, that can be liquidated in a lot of different ways. Some may be a little bit cleaner than others. A secondary sale, reasonably common. That's where one investor is selling directly to another investor. In our experience, that is normally a sale to some existing investor. It could be a sale to an outside third party, but normally the donor and more often the company do not like to see charities selling to outside parties. And in fact, the shareholder agreements may prevent exactly that kind of sale. So you may not be able to, but a sale within the ownership group is pretty common. And those are usually pretty clean because the charity is not required to make a ton of representations as to the activities of the company. The buyer already owns some portion of stock. They're already involved in the company. Funding round is another way to sell startup stock. Same way you bought in, usually funding round, you're just going to be selling, you're tendering your shares into another funding round. Again, reasonably common. If the company is just sold wholesale, it's another way to get an exit with startups. And then finally, sort of the classic IPO, the company going public. That may seem like the cleanest option because you've got this private stock and now it's become public stock, and your charity can accept and sell public stock all day long. That's great. That's easy. Maybe not so fast, because when the company goes public, the existing investors are usually subject to a lockup for at least 6 months. That means sure, the company's public now. In theory, you'd be able to sell, but because you were a pre-existing investor, you can't sell for at least 6 months, often 12. And so you have to wait some period of time to sell that stock. And what's more, if your donor was an insider or is an insider at the company and they have inside information, you have to be really careful about taking the donor's advice as to how and when to sell your now public stock. There's a lot of securities laws implications there. I've had many conversations with donors and securities counsel about that. And although the investment is separate outside of the insider's ownership, you don't want to be getting accidentally inside information and then trading on that. Best avoided in any case. So those are the options for monetizing these investments. Startups probably the most complicated and the most different directions that you could pursue to find liquidity.
And Ryan, if I can maybe pause, so I'll interject some things too, and we might even want to add some of these for Thursday because it's just stuff I sort of popped in my head. But maybe 3 things from a practical perspective. So can you maybe describe broadly what we do from a disclosure, I should say a disclaimer standpoint with our sort of process for, let's say a donor came to us and said, look, I'd like to make a direct investment into, a particular private company. So can you maybe just sort of describe that in the sort of the 1-minute overview, which I think goes to the sort of due diligence side a little bit, but also the monitoring side.
Yeah. So what we do, I mean, we pretty much disclaim everything. We say, we'll monitor this to the best of our abilities, but we're not financial professionals, and we're certainly not the donor's financial advisor. So we will try to realize the best possible return from this, but we can't make any promises. We can't make any guarantees, nor can the donor, control our investment. And what's more, if the investment does not perform as expected, we disclaim any responsibility for that. That's probably the most important part. And I think, I'm not sure this is in there, but it should be. We do this for crypto. We really disclaim any responsibility as to trading and selling the investment, because again, we're not financial professionals. We don't trade securities for a living. And so the idea from the donor's perspective that we may be able to trade the stock as well as a professional broker, you really have to disabuse them of that concept.
Well, and one thing too, we worked with our outside legal counsel, we meaning Ryan yet again. I don't know how long that was, maybe a 12 to 18 month process at least to develop this. And I can't remember if this was a case or it's in my head or something, but there was something where I think it was a community foundation that was donated stock. And in this case, it was simply said where the donor was like, hey, wink, wink, I really want you to super strongly recommend that you hold this stock. I think it's going to go up. And wink, wink's probably not the right term, but you get a non-binding, I really think the stock's going to go up. And everybody on this call knows exactly what happens. Like 93% of the time that donors say the stock's going to go up, of course, it goes off a cliff. Stock goes off a cliff. And then I think, if I recall correctly, like the donor either did sue or threatened to sue the charity. Like, whoa, like you were the CEO of this company or something. I don't know, somebody that was pretty high up that was supposed to know. And he's like, yeah, but that was non-binding. You guys have a fiduciary obligation to basically tell me no, and you should have sold it. And now you've impacted my donor advised fund by X amount. I'm like, what? To me, that's insanity. But I mentioned to every donor that wants to do something as a direct investment, I said, you're going to read our disclaimers. And if you're not laughing, you're not reading it. Like, if your non-binding recommendation is for us to invest our legal funds within your donor advised fund, it can go down. And you're not yelling at us if it goes down because you are making this recommendation, initial DNA sample, not quite that bad, but you get it. So I think it's just important to understand the tenuous sort of nature between the relationship and this fiduciary oversight. The second thing is Ryan mentioned on the last slide about donor involvement. And in many ways, it's great to sort of have the donors involved, again, from a non-binding recommendation, which suggest advised standpoint, but also in particular, if this is in a private foundation, donor advised fund, CRT, that anything that otherwise could create some kind of excess benefit directly or indirectly, we are usually really having to probe that on the due diligence side, where it's like, oh, this is a great fund. Well, how do you know it's a great fund? Because I'm the manager, I'm the GP of the fund. Like, okay, whoa, that just changed everything. Now you're basically getting, direct or indirect compensation through the investment otherwise that we would be making. So can that be carved out, or other kinds of things that we have to do? So that's just important to understand. Also, Ryan mentioned that I really want to emphasize is to the extent they're an insider, that information usually just completely stops. So in a weird way, the closer they are to the information, the less information that we have. So kind of counterintuitive, but that's how that works. Final thing is I usually get questions, certainly from the donors and their advisors, around fees, because the question would be is like, if we're managing this or some other charity is managing it, this takes a fair amount of work on the front end, certainly monitoring as you go, working with the auditors, all those kinds of things relative to changes in valuation. And at least for us, if we think that it's a going concern and it's not sort of plummeting, that we typically will accrue fees until the time there's actually some liquidity, whether that's a partial distribution or redemption or full, whatever. So we typically accrue that. And the final point that I wanted to make was we learned a lesson, I think, in a hard way about, because if you're working with a company that does have an insider and you have very little information, that I think Ryan and I have sort of decided it's more of an internal policy to have some level of selling if we're not getting that information, because we had one position, like it went up 4 or 5 times and now it's gone down like 95% since then. So it can be like, look, you're not going to give us as an insider specific recommendations to sell. You can't, we're not messing with the SEC, but if the stock goes up, if it doubles, then we're going to sell 30% at that time. So basically these sort of selling rough triggers, with disclaiming it, like if it goes up there for 10 minutes or something, we might miss that, but here's sort of our general guidelines about what at least the path would be, just so we can hopefully prudently manage what are most always a very volatile position. Not always, but often. So those are my things I just wanted to make sure we're set here. So I'll turn it back over to you, Ryan.
Yeah, no, and I mean, that goes to kind of some of the sub points I've got here on this fiduciary oversight slide, where I say, you can get burned by waiting too long. As Brian said, we've experienced that very painfully. And so, what should you do? Maybe have some policies and thresholds in place as to when you do want to either strongly recommend an exit or insist upon an exit from the investment. Those you I think can avoid a lot of headache on the back end by having those policies in place and making sure they're disclosed. More generally, particularly if it's a larger investment or if it becomes a large investment, which is normally a good thing, is that going to have implications for the rest of your charity's assets, the rest of your investments? Is this investment now overweighted in your investment portfolio, and do you have to consider reallocating other positions? That's something that you'll want to consider. And let's see. As far as UPMIFA goes, there are a couple things to consider there. One of the changes from UMIFA to UPMIFA was the addition of the charitable purpose doctrine. You'll want to consider whether this investment satisfies your charitable purpose. And this is a conversation I've had with usually it's more environmentally focused charities, where they're sensitive to the sorts of assets they're taking in. You can see how that might be problematic. For us, we've often looked at investments that have some sort of health oriented focus, or at least some nexus with sort of human health. It's not a formal policy, but that's always kind of made us feel better about the investment if there is some sort of human healthcare or environmental nexus to the investment. So it's something to keep in mind from an UPMIFA standpoint. And then the other big change from UMIFA to UPMIFA, can the charity use cash from the investment if it's below the original investment dollar amount? That's something you'll want to consider with the donor. Make sure your policy on that is stated up front. That was one of the big hangups with UMIFA, is that charities couldn't touch investments that were below, I believe the term was holding value. It's allowable now under UPMIFA, which is the law has been adopted in every single state plus DC and Puerto Rico, except for Pennsylvania, weirdly. So most states will allow the charity to use cash from an investment that is underwater, but I think it has to be disclosed to the donor to satisfy the requirements of UPMIFA. So that's something to consider as well. And then finally, to do an investment like this, presumably that's going to be a deviation from the existing investment policy statement that your charity has. Who has to approve that deviation? Is it the board, CFO, CEO, all of the above? Again, you'll want to know that ahead of time. And then Brian, I think you were going to talk about these kind of broader charitable payout considerations here.
Yep, I was just typing one of the questions. Actually, you might jump into the Q&A. There are two good ones in there. I think one you covered a bit on the fiduciary side, but one other one. But this is around sort of aggregated charitable payout. So interestingly, one of the strangest ones that I've ever come across was not us. And this is going to be very odd to verbalize, but sometimes the worst thing that can happen is, as Ryan mentioned in the last slide, you could have an investment that sort of comes in at X, and this sounds so weird, but God forbid it becomes like 50X. And you'd think that that's like the best thing ever. Maybe not. So if it's illiquid and it goes up a lot in value, then you've got the issue relative to sort of your overall payout, to the extent you're an endowment or even a community foundation, et cetera. And so there's sort of that piece. But interestingly, because this was sort of aggregated as assets for this particular charity, people thought, oh my gosh, it's like the best investment charity ever. But wait a minute, my funds did not go up anywhere close to that amount. Well, it was just one separate fund that was large, but became enormous, almost like doubling, if not tripling the size of the charity overall. And then the flip side of that was then the asset went way, way, way down in value. So then it hit all these other potential reputational PR news risk of, oh my God, they're the worst investors ever. Well, it's the same investment, but it was just this one that was outsized. So you just want to be very careful. You can see sort of the asset, is it material, relative to your overall assets too. We have, again, about 500 to 600 million in these types of positions. We're around the 2 billion or so. So it's about a third-ish. But I think that maybe is made up in maybe 15, 20 different positions, if not even a touch more, in terms of individual donor advised funds. So it's able to get some smoothing there and sort of not overall sort of tilting us in sort of a too concentrated risk position. Plus all we deal with are illiquid gifts anyway. So we're sort of already in that space. But you can see too, a number of large audit firms require periodic, that might be once a year, every other year, mark to market, in essence, qualified appraisals. That's not a 10-minute, $10 process. And so there are some very, very large charities that will not either just take in illiquid gifts and hold them longer term, or sort of make direct investments, because now they're right back into this potential bucket of having sort of mark to market valuations to make sure that the 990s and audited financials are correct too. You can see there too, again, a non-qualified audit. I've never had this come up until about a month ago. So we have a client that took in a very large, very unique, sort of like a biological material, very large. And turns out that when the auditors literally flew to another state to look at the inventory, it was not overly consistent with what the appraisal said. So if you're supposed to have, I don't know, like 5 milligrams of X in every one of these beakers, that's not what it was, but you get the gist. Like, well, wait a minute, this one had 5 milligrams, this one had like 6.2, this one had 3.2. We aren't comfortable now signing off on the audit, so therefore it's unqualified. And so it's one of our clients, and they are now going, oh my God, now what do we do? Sort of as an example. So never thought that could come up, but again, we worked on that last couple of weeks. And then what if the asset is not producing any income or is limited? So we hear about a lot of this with farms. So a lot of farmers would say, no, I'd like to keep my farmland, in perpetuity or something like that, which creates a whole other set of issues that we're not going to go into. So that might have we'll make up $1 million value for that farm, but it might be leased out at 1 or 2% if you're lucky. So now you've got $1 million asset producing 2%. So that might get back to potentially, is that fiduciarily acceptable and appropriate, when otherwise that maybe could be sold in the open market? That 1 million could go into a T-bill right now at 4 or 5%. And now you're doubling the charitable impact. So you've got to be a little careful about what does that mean. And then two, what if it becomes a very large asset relative to the balance sheet? And therefore, then the 1 million became 100 million paying 1%. Now how can you actually up MEFA or otherwise be able to make grants to sort of hold up the payout too? And I mentioned sort of that extremely volatile. So this one charity, including us, we've had charity, we had an asset come in at, I think, Ryan, you'll wince when I say this, but I think it was around the 90 million, and it dropped to 10 million in about a week, 10 days. That's the nature of some of these things. So this was not necessarily a direct investment, but said another way, in essence, it becomes almost a de facto direct investment if it otherwise could have been sold. So that kind of creates a philosophical, if we're holding it long term, but we otherwise could sell and then invest in a more diversified portfolio, now basically saying it's almost as if you had the cash and you were investing in that particular asset. So most of these are extremely volatile. And the next slide, I'll maybe just hit these, Ryan, just for sake of time. We'll see if there are any questions too. But, and maybe we all think about sort of doing this at the front part, because a lot of what we're discussing, I hope, was not unclear that this would be where donors are maybe making a recommendation for direct investment into the charity's broader endowment. I certainly think that may happen, from time to time. That is not what we see sort of at all, given our structure. So again, these are really siloed investments. I would also say that we do this for maybe 500,000 sometimes. These are probably averaging in the 15 to 30 million. So these tend to be very, very large. I think even for us, that sort of million plus starts to get some good, relatively good economies of scale, because this is very high touch, due diligence, monitoring, sort of risk component for these. So the point is that we, our DAF is able to sort of do this directly. Other ones certainly do and may as well. But the point is that there's some sort of cross-pollination, if you will, sort of among DAFs, community foundations, about sort of who is comfortable doing this, who's not. As Ryan mentioned, even if we're doing a direct investment itself, when we need that liquidity or a capital call, I'd say probably half maybe of our investments are coming from other community foundations or DAFs. We're then making that investment, holding that in our donor advised fund. And then when there is liquidity, then we're turning around, because we don't manage it once it's liquid, and sending it back to that DAF or community foundation. So there's, again, a sort of an ecosystem and flow that sort of occurs here too. Designated fund I only put on here because we do see this from time to time. If there's going to be a potential excess business holding issue, that DAFs are subject to that. Private foundations are subject to that, as are type 2 and type 3 supporting orgs, but designated funds are not. So there are situations from time to time that a designated fund, irrevocably designated one or more charities, cannot be changed after funding, but that may be an appropriate vehicle for something like these concentrated or direct investments as well. Supporting orgs, we've done whole webinars on this, so I won't go into it too deeply, but very similarly, that is a separate and distinct legal entity, its own tax ID. that can do these. And we see that a lot for very large positions. And then LLCs. So Reynolds Cafarata did a great LLC webinars. I hope many of you enjoyed. But same thing. This is a very common vehicle for these types in particular of direct investments, because we're already making the direct investment into typically a limited partnership or an LLC. So sort of using those two as well. So that's really the charitable overview. We have a little bit of time for Q&A. Maybe while we're doing that, Ryan, you can maybe just jump to the webinar slide, just so that those are up, so you can sort of see there. Looks like May was the charitable gifts of LLCs. You can see my little joke in the Q&A was around the long live the donor. That did that back in March. And I led this with more and more donors are motivated to make donations and hold them long term because of this sort of motivations and philosophical trends. That was sort of the February one, but you can see a whole bunch of other ones here that might be helpful to you as well. Are there any other questions here, Ryan, that'd be good as we are getting ready to close it out?
I don't think so. I think you were maybe midway through an answer about the IRR question, which I don't know if you want to answer that live. That might be easier to answer in writing.
I just sent it, but I will.
Okay.
Yeah, so I was midway and then I finished it up. So the quick of it is, it really gets back to that vehicles side. So we are not, we'll look at particular things from a due diligence side. And if their revenues are kind of looking like this, that's not a good trend, versus this. But generally, the donors are putting their own charitable capital into these. They're usually very, very sophisticated donors. I would say are probably average. I won't say is a billionaire, but it's probably pretty close, frankly. And so that they are sort of doing that, they've done their own due diligence. In many cases, they are doing their own personal investments, non-charitable. And then this is sort of a sidecar piece as well. So the point in all of that is we are not sort of trying to determine, what an IRR could be, because that whole IRR, positive or negative, is going to inure to the donor's fund. And so because of those disclaimers that we used, we just don't go into that much level of detail around that, because it's not impacting our overall endowment. It's not impacting other donor funds. So it's a great question. So with that, how do we figure this out? I think it's dead on 1 o'clock Eastern. So I do hope that this was helpful. And in particular, again, the motivations that more and more donors we're seeing doing this. Again, think about the Warren Buffett. You can think about the sort of effective altruism movement about how to maximize both earnings as well as asset investment growth, and how they're doing that in the charitable sector. And so more and more we're being asked for donors and their advisors, is it possible to transfer over a large publicly traded position and not have it sold? Is it possible to transfer an office building in real estate and it not otherwise be sold? Again, not a material restriction, a recommendation for that not to be sold. And is it possible for our donor or our client who has an opportunity to invest in some hopefully healthcare environmental thing that Ryan mentioned, is it possible? Is there any way that that could be done through a charitable vehicle, because he or she doesn't want or need the money anyway, but they think it's a great investment opportunity that will eventually have a maximum or optimal charitable impact? The answer from all this is yes, with a lot of devil in details and a lot of caveats, but it is possible. So with that, I will close. I hope it's been helpful, and wish everybody good luck. And Ryan, fantastic job. Thank you very much.
Great. Thanks all for attending.